Hey everyone, how are you? This is Chris Urso. Hope all is well. Wanted to put together a little bit of an update for this month. Hope everybody enjoyed their summer. Thought it would be good to kind of take you through a little bit of our pipeline process, what we're doing in today's environment to build a portfolio like you see here. Earth Capital has done 29 deals since inception. That consists of 25 traditional acquisition value add properties and four ground up developments. So in total, between our ground up and our acquisitions, we're over 5,000 units since our first apartment deal in December of 2009. So for those of you that don't know us, our approach has never been high volume in terms of deals. So if you look at that, we've averaged since inception really only about 2.5 deals a year. Over the last 5 to 7 years, I'd say our normal average is anywhere between 3 and 4 deals every 12 to 18 months. That's been very light in the last 2 years. We've been net sellers. So as you can see here, sold, sold, sold. These are all the assets that we've sold. And 10 of those deals were sold between 2020 and the end of 2022. We actually have another deal in the market right now that we're in the process of selling potentially. We're marketing. It's got an attractive loan assumption. We've got a large amount of equity baked into it, and we think we might be able to take some more chips off the table and reload and be ready to redeploy in the next 12 to 24 months at some better pricing, potentially. So that said, our approach is really more to look at a ton of stuff and be opportunistic in our approach to find value. So, that'll consist of, talking to brokers, talking to owners, property managers, having our site teams, having our corporate team, acquisitions side, Chris and Quentin, out in the market, going to tour deals and see what else they can drum up on visits and to build out a pipeline. In the last year and a half, as I've said, really year and a half, we've bought one deal and we've started one development. So we've been really light on the acquisitions. We've been really heavy on the dispositions over the last 2.5, 3 years, intentionally. We've brought our portfolio down to where we have 5 existing assets in our portfolio now, plus the ground up project in Asheville that we just started. Our corporate team is the biggest it's ever been by design. We have our management platform established and running. We took that in-house back in February, all in an effort to be prepared to capitalize on opportunities as they present themselves. We're starting to see some small cracks in the market. I've had a lot of conversations with many of our investors one-off in terms of what we're seeing. I know everybody's excited, anxious, not anxious, excited to see some opportunity. We're seeing pricing come in meaningfully in some instances and marginally in others, depending on the product type. I will tell you across the board, it's probably about 10 to 12% off peak pricing that was established back towards early 2022. So, things are moving in the right direction. Nobody's immune to what's gone on in the interest rate environment. It's been a challenge. It's a challenge to underwrite. It's a challenge to operate through by all means, but that's going to create opportunity. It will come to a head. I'm going to do another piece on loan maturities for next month, but this, I wanted to just kind of talk holistically about our pipeline approach. We are targeted. Many folks that don't know us think that, we're based in New York and we just look all over the country for opportunities. That couldn't be further from the case. We really stay geographically where we've either had a presence or we currently have a presence. And that's really North Carolina, South Carolina, Savannah, Georgia, MSA, and the Nashville MSA. We are looking at other parts of Tennessee as well that could be interesting as our footprint is expanded. We've got some good boots on the ground throughout the Nashville area and built some great relationships with our current projects that are going on there. But to get to those 3 deals a year that we strive to do, 3 to 4 deals, historically, we build our pipeline out, right? And we track our pipeline. So it's really all about getting deals in the door. And we don't have one box. So let me back up. I think I touched on this. We don't only look at 2000 and newer vintage properties. We don't only look at 1980s and 90s properties. We don't only look at 70s properties. We don't only look at development. We are really value driven in everything that we do, whether it's development or traditional acquisitions. And that could sometimes result in, as you've seen here. So, for example, Pooler Station. This was when we bought it, was basically a 2016 built property. Latitude Richmond Hill, 2006, 2016, 2019 built property. Gastonia, 174 units at destination. That was 1990s. Oasis at West Ashley, 1970s. 4375, 1970s. Nova Ridge, late 1960s, early 70s. So we really run the gamut. Plantation Flats, 1980s vintage. North Lake was 1980s vintage. It's where we can identify value. And that sometimes can be in a brand new property that's in lease up, where we feel like we can get a meaningful discount in today's environment to replacement cost. Meaning we could take all the development risk off the table and buy this property today that's only 20 or 30% occupied, but maybe it's 10, 15%, 20% below what it would cost to build that property today, and there's embedded value in that alone. And then others, it's going to be buying older assets that need major capital injections, and some other examples could be just buying from mom and pop operators that have owned assets for 20, 30, 40 years, and they're not familiar with the market around them. They're leaving a ton of rental upside. They're not operating it to today's tenants and marketing to today's tenants in terms of giving them what they want. So to do that, we've built relationships now over the last decade plus with, some of the biggest brokers throughout the Southeast, and we're very fortunate for that. Folks like Cushman Wakefield, Berkadia, Capstone, CBRE, you name it. And these are guys and gals that we've all kind of grown up in the business together. And now Chris and Quentin have kind of taken the next generation, the younger guys that have come into the business, and they've been forging relationships with those guys over the last 3 to 5 years. That's our primary feeder of of acquisitions. And given that our goal and business model, historically is 3 to 5 deals, 3 to 4 deals every 12 to 18 months. That may get condensed in the next 24 months if there's opportunity. But our relationships, our top 3 to 5 relationships, typically feed us the majority of our acquisitions. And that's where we spend the bulk of our time cultivating those relationships. We rely on them plus our own internal databasing and researching, and then work with them and building pipelines out. So a lot of what I'll talk about on the next update is looking at loan maturities, construction completions. We just had a call yesterday, with one of our guys from Cushman that we're close with, and we went through all the completions in North and South Carolina that are targeted for the next 12 to 24 months, looking for unique situations, whether it's deals that we can tell based on when loans were originated that, okay, this construction ran way long. This project, a similar project, should take 2 years. They're now just opening up, and they started the project in 2020. Or the project was completed back in January of 23, but they're only 20% leased up right now. Is there an opportunity there? The profile of the developer. Is this a small-time developer that maybe does 1 or 2 deals, their first deal? Is it a home builder that just got into building multi? If it's a big merchant builder, national builder, we tend to pass on those. We're looking for those unicorns where we can potentially come in and execute a deal, move very quickly and efficiently, and buy value on the newer product. On the existing assets, we're looking for situations, right, and stories there. Where is that opportunity? Where is that value that we can unlock? So, since I have to black out property names for confidentiality purposes on a lot of this stuff, but this will give you an idea. Just since January of this year, we've basically underwritten. These are every deal that we bring in the door to underwrite, 61 deals. And counting, and we haven't bought 1 deal this year. We broke ground on 1 development, but that project started, a year ago. So that gives you an idea of what we're doing on a daily basis. So we're putting it into underwriting, passing, offering, not accepting, and then Chris and Quentin are responsible to meet every week, and Chris does a great job of following up, right? That's how we've gotten some of our best deals over the last 10, 15 years, is being the guy that's there for number two or number three, where we might be told no at our initial offer, and then we hang around the hoop. We check in every week. How's it going? How's it going? How's it going? And buyer drops out, and now, hey, you know what? The seller says, hey, I don't want to go back to market. Who's next in line? Who's going to get this done? And they're willing to sacrifice price for certainty at that point, because they've tested the market out, they've exhausted their staff, and now they want to get a sale done. And that's happening more and more. Those are some of the cracks that we're talking about, where we're seeing deals that we underwrote and offered on back in March or April are now coming back around. Deal fell out, insurance costs are too high. Deal fell out, buyer couldn't get their equity together. Deal fell out, their debt was too expensive. They couldn't get the leverage that they thought that they were going to get. Now, still not at our pricing that we want to buy those deals at, but the fact that it's happening, we lived through this in 2009, 10, 11, 12, 13, 14, 15, 16. This is how we built our business, is being in the market, being in front of brokers, being super efficient and diligent with our pipeline. And these are the same tools that we're using today, and we're underwriting back to those standards of 2012 to 15, where it's, hey, you know what, we're ticking vacancy, we're ticking bad debt higher, we're lowering rent growth, and we still need to hit our return metrics with that cushion embedded into the deal. And that's where we're offering. And more often than not, we're going to be told no. We understand that. But as you can see here, we're tracking the market, the status of the deal, the call for offers date if it's on the market. Ones that don't have a call date means it's off market. The market that it's in, the vintage, the unit count, asking price per unit, where we offer. And then we're tracking cap rates, which is, cap rates are moving, but deals are still transacting at meaningfully lower cap rates. As you can see, 4s, 5s, this one is obviously not accurate, but 4.9, 5.7, 5.2, 5.1, 5.5. We're taking the T3 income over normalized expenses adjusted for taxes. So wanted to kind of share with you what we're doing, what we're seeing in the market, to give you an idea. And we tracked this pipeline all the way back, to last year, basically. So last year was super light. We didn't really do much. We knew the pricing was out of whack. We were waiting, and we couldn't be more excited. Personally, we were able to accumulate meaningful amount of dollars through the sales that we've had, and we've reinvested into high quality some of our developments, and we've put together a large tranche of personal capital amongst ourselves and our employees to be able to go back into the market when we feel that there's that perceived value. And some of this stuff is going to be hard to make sense in the near term, but we're going to see the value in it if we put that normal 5 to 7 year hat on. I think we all got a little bit spoiled buying deals in 2021 or 2020, selling them in 2 years later and 2xing equity, 2 or 3xing equity. That's not the norm. We're in this business because it's resilient, it's fairly defensive in nature, it's consistent. When you look back over the last 50 years, you'll see very consistent growth on top line rents. It is an inflation hedge. And then separately, what you'll see is vacancy, unlike other aspects of commercial real estate, really has never dipped below 10% in multifamily on a national level. And retail, office right now, obviously, that's in a lot of trouble. But we're going to see some dips. It's going to ebb and flow. The next 2 to 3 years is going to be a challenge for sure. In all aspects of commercial real estate, with rates where they are, the economy slowing up a little bit. But that's where opportunity is going to present themselves. And we've done our best to position ourselves in a place where we can play offense. We have a small amount of deals in our portfolio that can get a massive amount of attention. We have the most amount of people on our team than we've ever had. So we're able to deeply focus on those assets. And now it's time to play offense. And that's the mode that we're in. So if you're interested in learning more about what we're seeing, if you're not an existing investor, please reach out to us. If you're an accredited investor, please reach out. So you can reach out to Rebecca at urscapitalpartners.com. And if you have any questions, please feel free to get in touch with us. Thanks so much.